Contract for difference, CFD. Leverage trading and market speculation. What is contract for difference, CFD? A contract for difference, CFD, allow traders and investors an opportunity to make profit from price movement without owning the security or asset. Assets can include stocks, commodities, indices, currencies, and more. The value of a CFD does not consider from the security or asset value, only the price change between the trade entry and exit. How do CFD works? When an investor enters into a CFD position, they typically do not own the underlying asset, so there is no direct ownership. CFDs are considered financial derivatives, and their accounting treatment can vary depending on the accounting standards followed by the investor's jurisdiction and the nature of their business. CFDs are treated as financial instruments and are marked to market at the end of each accounting period. The profit of the trader is the price difference between the opening trade and the closing out trade, less any commission or interest. Example of a CFD trade. A stock has an price of $25 and the trader buys 100 shares. The cost of the transaction is $2,500. This trade requires at least $1,250 in free cash at a other broker in a 50% margin account, while a CFD broker requires just a 5% margin, or $125. Accounting entries for contract for difference. 1. When entering the CFD position. Debit, CFD asset credit, cash, or margin account if using leverage. 1. End of accounting period, mark to market. Debit, credit. CFD asset. Adjust the value of the CFD position based on the market price. 1. When closing the CFD position. Debit, cash, or margin account. Proceeds from the CFD credit. CFD asset cost of the CFD position. Does corporate actions apply to contract for difference? Yes, corporate actions can apply to CFDs. Since CFDs mirror the price movements of the underlying assets, they can be affected by corporate actions that impact the asset's value. Common corporate actions that can affect CFDs include stock splits, dividend payments, rights issues, mergers, and acquisitions. For example, if a company pays a dividend to its shareholders, the value of the underlying shares may decrease by the dividend amount. On the other hand, the value of the CFDs linked to those shares would also be adjusted accordingly. Thanks for watching. If you found the video informative, don't forget to give it a thumbs up and share it with your friends and subscribing for more content like this. See you next time.